Hello and welcome back to the channel. Today, we're diving deep into a fascinating microcap that's caught our hard-to-borrow screener's attention, ILLR Group Inc., trading under the ticker ILLR. We're going to break down why this technology/software application company is showing some extreme short interest metrics, what that could mean, and what to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, let's talk about ILLR. ILLR Group Inc. operates an artificial intelligence-powered technology platform best known for its video-sharing app ILLR. They also provide services like Streamline SMS, social messaging, AI-powered customer engagement, and cross-platform marketing in Hong Kong, the United States, and internationally. With a market cap currently sitting around $42.06 million, ILLR is firmly in microcap territory. Now, looking at the recent price action, ILLR has seen some volatility. It's down 1.23% today, down 11.7% over the last 5 days, but still up 7.11% over the last 30 days. Volume today was quite low at 436,900 shares, a stark contrast to its 30-day average volume of over 11.6 million shares. That means today's relative volume is practically Xerox average. What's cost to borrow and why it matters? One of the most critical metrics we track for potential short squeezes is the cost to borrow, or CTB. This is the annualized fee that short sellers pay to borrow shares before selling them. Think of it like interest on a loan. A high CTB indicates strong demand to short a stock, but also that fewer shares are available, driving up the price for those who want to bet against it. When CTB fees start to surge, it's often a sign that a stock is becoming hard to borrow. Why can fees exceed 100% annually? Because supply and demand dictates the price. If everyone wants to borrow a limited number of shares, the fees skyrocket. Why this stock is hard to borrow right now. And that brings us directly to ILLR Group Inc., ILLR. This stock lit up our hard-to-borrow screener with an astonishing annualized cost-to-borrow fee of 745.0%. Let that sink in, 745%. Not only is the fee exceptionally high, but the CTB momentum has also exploded, increasing by 603 percentage points over just the last 5 trading days. Furthermore, the shares currently available to borrow are extremely limited, at just 100,000 shares against an estimated float of 17.9 million shares. Our internal composite squeeze score, which factors in all these elements plus technicals, sits at a notable 50.3 for ILLR. These are significant indicators that short sellers are paying a premium to maintain their positions, potentially due to a scarcity of shares. Squeeze mechanics explained. So, what does it mean when a stock like ILLR becomes hard to borrow? It means short sellers are finding it incredibly expensive and difficult to maintain their bets against the company. A short squeeze happens when the price of a stock starts to rise, often unexpectedly, forcing short sellers to buy back shares to close their positions and limit their losses. This buying action further pushes the price up, creating a feedback loop where more short sellers are forced out, leading to an even more rapid price increase. It's a scramble to cover their shorts, and when borrowable shares are scarce, this pressure intensifies dramatically. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also indicate that short sellers have very strong conviction that the stock will eventually decline, and they are willing to pay these high fees to stay short. Dilution risk check. For any stock with high short interest, we always check for dilution risk, as new share offerings can flood the market and effectively negate a squeeze thesis even with high CTB. We're happy to report that for ILLR Group Inc., ILLR, our systems found no recent dilutive SEC filings such as -1s, -3s, or 424 BS within the last 90 days. This means the immediate threat of new shares being issued by the company to raise capital, which could depress the stock price, is not currently present. Recent reverse split watch. Now, something else critical to note for ILLR is its recent reverse stock split. ILLR Group Inc. executed a 1-for-10 reverse split on June 23, 2026, which was just 15 days ago. For those unfamiliar, a reverse split reduces the total number of outstanding shares and proportionally increases the share price. So, for every 10 old shares, you now have 1 new share at 10 times the price. Reverse splits reduce the float, which can sometimes amplify volatility. Historically, many microcap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the reset share price and reduced flow can attract new attention or trigger short covering. This is a pattern we've observed in some names, not a guarantee for ILLR, but it's an important factor to consider given the current CTB environment. Again, a quick reminder, important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For ILLR, keep a close eye on a few key metrics. First, continue to monitor that cost to borrow fee. Any sustained increase or decrease will be telling. Second, watch the shares available to borrow. If this number continues to shrink, it adds even more pressure to short sellers. Third, significant price and volume increases could be the catalyst for a squeeze, especially given the low relative volume today. Pay attention to any sustained upward momentum that forces shorts to cover. And finally, considering the very recent reverse split, watch for increased volatility or buying pressure that could align with the historical pattern sometimes seen in microcaps post-split. Triller Group Inc. ILLR is a fascinating case study right now in the world of hard-to-borrow stocks, especially given its astronomical 745.0% CTB and the recent reverse split. It offers a clear, real-world example of how supply and demand dynamics play out in the short market. We've covered a lot today about what makes ILLR hard to borrow, the mechanics of a squeeze, and what potential factors could influence its trajectory. If you found this deep dive into ILLR helpful, please give us a like, subscribe for more unique stock breakdowns, and let us know in the comments below what other hard to borrow stocks you'd like us to analyze next. Thanks for watching, and happy learning.